Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
You know, those trades that have a longer dated tenor, those options, especially when structured as a call spread, there really isn't a lot of gamma exposure on those trades. Obviously the sizes were massive, but I would imagine that the bid for volatility and the bid for, Vega as the market was ripping higher was more influenced by those longer dated stock replacement trades, while the shorter dated kind of consistent retail call block buying flow would have had a more disproportionate effect in the movement of the underlying stock itself.
All right, welcome everybody. We've got a fun day to talk volatility and VIX and option trading with the NASDAQ down about 4% today. It's Tuesday, September 8th. Now close to down about 10% from all-time highs. But the reason we're here is that volatility and the VIX haven't quite been playing along with this move lower. They haven't spiked to new highs. And in fact, before we started selling off, we were seeing some days of higher VIX and a higher market, especially in the NASDAQ. So what is all happening? We've grabbed two option VIX pros to talk it all through and to add to the discussion. Brought on Pat Hennessy, head trader at IPS Strategic Capital, and Matt Thompson, managing partner at Thompson Capital Management. So thanks, guys. Welcome.
Thanks for having us.
Thank you.
So Pat, you previously joined us quickly on the TVIX Gets Terminated pod, which was fun. Go check that out, listeners, if you haven't already. So some of our listeners will know you from that, but why don't you give us a quick elevator pitch of who you are and what you do?
Sure. So
How you get all that nice SIBO swag you're wearing?
I know Allie had pointed out that I think I was wearing almost the exact same outfit as the last podcast. So I swear I have more clothing. It just kind of lined up that way. So I am the head trader at IPS Strategic Capital. IPS is an independent registered investment advisor. We've been in business since 1993. Our specialty is in providing our clients with hedged equity solutions. Those come in a variety of flavors. We manage a 40 Act mutual fund. The ticker is IPSAX. And that is kind of a all-in-one product that will provide upside market exposure combined with a downside hedge built into it. The goal there is to, outperform the market over the course of a full market cycle, which seems like we've seen almost 3 full market cycles in the last 3 years. And we also provide custom tailored hedging solutions, and we run a long volatility strategy, not really a tail risk strategy, but more of a long volatility overlay that can be put directly into someone's equity portfolio. And we manage that as a separately managed account, as well as a few other separately managed account solutions that are, focused on providing asymmetry to the equity markets.
Perfect. Good. A longish elevator, but it was pretty good. And Matt, thank you for joining us on your first episode of The Derivative. What do you got going in the fish tank back there?
Oh, those are my freshwater sharks.
Freshwater sharks. All right.
Yeah, right. Now I feel like a Bond villain or something. I need to have a cat that I'm stroking here.
Yeah. Sharks with laser beams on their head.
That's right.
So give us you and your brother Mike started Thompson Capital Management. We've known each other for a long time in this space, but give us a quick background of where you started and how you guys formed your company.
Sure. So my brother Mike and I we're born and raised in the Chicago suburbs, and started on the traditional buy side, that big firms in Chicago, and then along the way have worked our way into more volatility specialists, VIX derivatives, and then started Thompson Capital in 2019, just last year. We're an RIA, and we do risk managed strategies for other advisors generally.
Perfect. And you're pretty active on Twitter, both of you, talking VIX and all things volatility. So thanks for sharing all your thoughts. So yeah, I want to dive right in here and just get your guys' thoughts on what we've been seeing in the past month. It seems, starting with the NASDAQ kept making all-time highs, and the VIX wasn't falling. It's been kind of staying right at this 27 to 32 range. So we'll start with you, Matt, just of your overall thoughts on what kind of environment we're in and what's happening there.
Yeah, it's been goofy really since I would say really since the August VIX expiration, so kind of middle of August forward even to today. Point to point, I guess it's been about the normal relationship. S&P's down a little, the VIX is up a little, but the path has been strange where you've had a lot of this positive correlation. Especially in the back half of August, we had, I think, 3 or 4 days when VXX, the long vol ETF, was up, multiple percents as S&P was just chugging along to the upside. You usually don't see that even one day, let alone 4. And now, then the market really starts to turn south, and VXX is down when the market's down 2.5. So it's just some real unusual, consistently positive correlation between two indexes that are supposed to be negatively correlated.
Pat, how about you?
Yeah, so, one of the things that I flagged on Twitter and was, really a theme in late August was the persistent bid for both index volatility as well as, the bid for the underlying equity. I think the market was up something like 5.5%, while the VIX was up about 20% in the same time frame from August 20th to the beginning of September. And, there's no way to know for certain what exactly is driving these things. And I think a lot of the narratives that come out trying to place a, why behind the moves that happened, it's just doing our best to try and figure out what could be driving this. But I think it was pretty well documented that there was an exorbitant amount of both retail trading, very short dated call options, and large cap single name, tech stocks, as well as a large player, potentially multiple large players that were implementing stock replacement programs in the same names. And what you see and how that kind of translates into the index products is that there was a lot of optionality, gamma and vega, that was being purchased in these single names that can be extremely challenging to hedge within those same single names. And so you saw dealers and market makers start to reach into the index products where there's a little bit more liquidity to try to help hedge off some of their risk. And I think we can go into the difference between those two styles of trades and how each, the retail trader as well as the stock replacement traders have influenced both the price of the underlying as well as the volatility of the underlying. But needless to say, when the correlation between SPX and VIX tends to break down, whether it's on the upside or the downside, it's always something that tends to be very important and market moving.
And so let's unpack that a little. So we talked about offline, Ben Eifert put out a nice thread on Twitter of talking through what's happening. What you just said, there's two pieces to it. One, this retail flow. Two, everyone was saying SoftBank bought $40 billion in call options. It later sounded like maybe that wasn't necessarily the case. It was kind of a covered calls, or not covered calls, but buy rights. What was it?
Stock replacement.
Stock replacement. Wait, someone explain stock replacement for me and the listeners.
Sure, I'll bite on that. So stock replacement is a strategy where if you are, long, let's just say for the sake of an example, you're long a portfolio that resembles the S&P 500. What you might do in a situation where you want to actually take some risk off of the table is you would replace that position, that underlying stock position, with call options. So, what we saw in the, large cap single name space within a lot of these large tech stocks is you were seeing, these massive call spreads and risk reversals trading. But these trades were being done against an underlying stock position, which just means that if I'm, buying a call spread, which is giving me long exposure to the underlying, at the same time, I'm selling my stock against that, meaning that the effect on the underlying security is
net zero.
Very minimal. And so, I think that a lot of the, chatter after hearing about these large trades was that, SoftBank is pulling a page out of the Wall Street Bets, trading manual and trying to, take on a crazy amount of risk, when in reality, these trades are actually far more risk averse than owning the underlying stock. And it's freeing up cash for them if they want to, look to repurchase the shares if there was a pullback. So I think, one of the things is that you should not immediately associate what happened in these stock replacement trades as some, extremely erratic, over leveraged, overly bullish bet, because that's, generally not the case with stock replacement. It's actually
when it's the same group that funded WeWork into the ground, it seems like they are risky, right? It seems like, well, if they did that,
it was like, to have it be that bank, that institution, everyone was like, oh, really, these guys? And so it lends, it makes the story just perfect. Then you could run with these big numbers from SoftBank and make it into something that has a kernel of truth in there.
Right, but so stock replacement, I've got $1 million in stock. I'm going to sell that. I'm going to buy $1 million worth of exposure, quote unquote exposure, for whatever, say 250 grand.
Yep.
Right, and just my premium paid, so I can just risk my premium instead of my whole principal amount. Is the concept there, right?
Right. Yeah, you're actually taking risk off the table in that with that approach.
And in theory, not giving up an opportunity cost. But if it just keeps chugging along, I'm going to give up my premium spent. So,
right.
All right. So that's one side of it, but we're saying probably not as big of an effect because it's a net zero. They're selling the securities in order to buy the premium, which you'd think would, perhaps in the short term, could have short-term selling pressure on the securities, or the ARB there would immediately cover that with the option purchases.
Yeah, usually that would be done, concurrently. So you'd figure, or right around the same time. So you'd figure that the net effect in the market of that whole position shouldn't be too great, depending on how they legged into it and everything. But the bigger I think push was this big tidal wave of these smaller lot options from presumably retail, flowing into those big FANG names. Those were probably not as sophisticated as a stock replacement strategy. That's probably more like give me leverage to the upside and a few names that that go up every day. I could see that and being a bit more of a directional kind of push.
So let's talk about that. So that's Robinhood gets thrown around there, but it's come out that it's probably way more than just Robinhood.
Sure.
Kind of across the board. But the theory there is all these retail, which means small investors buying less than 50 contracts or something, are buying up these call options because let's get into the why. But for a second, just they're buying up the call options. The dealers that are selling them the call options don't want the exposure, especially now after seeing NASDAQ run up. So they're immediately delta hedging that by buying the underlying stock.
Right.
Who wants to dive into how all those mechanics work for a sec?
Sure. I'll take a stab at it, and Pat, I'm sure, can tell me where the holes in this explanation. But it's a similar idea to stock replacement, except you're not replacing any stock. So now get rid of that short component to that whole equation, and you've got this big flood of directional exposure that comes into the market. And it's usually, if it's coming from that retail set, going to be smaller orders, and it's going to be much shorter dated. So, a couple weeks to expiration. So it's the most leveraged kind of upside you can get out of calls. And it's coming all kind of in mass as these retail accounts go out, and everyone can trade options these days. So you can go in to your Robinhood account and hit the bid on a 2-week option in Tesla, and that creates this negative exposure for the dealers, especially that real short-dated exposure in a real volatile name like Tesla or any of the FANG names. Those dealers want to lay that exposure off as quickly as possible, and so they're going to turn around and do what they have to offset that exposure. Buy the stock, or as Pat mentioned, start buying the indexes, go buy vol products, and so you have this sort of unbalanced bid for that vol in those short-term calls.
So why, naively, I would think, putting myself in the listener's spot of like, why not, isn't there a big enough market where these retail traders can buy from other retail traders that are wanting to sell it? Or we're saying there's not a market out there, the dealers have to step in. Like, it always confuses me of why are the dealers such a big player? Isn't there a market on both sides for all of this?
Well, the flow is very much one-sided. There's I can't imagine why any, retail Robinhood trader would want to be selling calls on something like Tesla or Apple. And so I think, what you're seeing is that it's extremely one-sided flow.
Or that the brokerage would even let them. They might say, you got to have like, whatever, $20 million up in order to sell a naked call, right?
Right. So I think that the very short-dated trades, Matt said that they tend to be sub 2 weeks expiration, and that's really where a lot of the gamma exposure, options basically have more gamma the closer that they are to expiration. And so
that's a fancy way of saying they're going to react more to the closeness or to the strike price, and they're all price driven at that point instead of necessarily volatility driven. Sure.
And so I think one of the important points to disentangle between the two is that these SoftBank, or if it was SoftBank or whoever else was doing it, those trades that have a longer dated tenor, those options, especially when structured as a call spread, there really isn't a lot of gamma exposure on those trades. Obviously the sizes were massive, but I would imagine that the bid for volatility and the bid for, Vega as the market was ripping higher was more influenced by those longer dated stock replacement trades, while the, shorter dated kind of consistent retail call buying flow would have had a more disproportionate effect in the movement of the underlying stock itself. There are two different components when we talk about, the gamma has become such a hot topic in the markets. There is the effective trades when they take place. So, meaning that there could be an imbalance between buyers and sellers. And then there's the ongoing hedging obligations of these market makers. And so I think what you saw is that, these market makers were short a lot of calls in these very short dated expiries on stocks that were going up, 5-10% per day. And they were being forced to buy shares just to hedge their positions. One other thing that's very interesting about the way that the short dated call flow works out is if you look at a stock like Apple or Tesla, and you look at Bloomberg has a feature where you can look at the most active strikes on a given day. They're almost always the short dated 1 to 2 weeks expiry options. But if you look at the open interest, it's almost always still in the, large quarterly expiration, September, December. Anecdotally, I've heard that these retail traders tend to go home flat. They're day trading. It's not positions that they're holding overnight. And so, what you're seeing, that effect there is basically causing larger intraday moves in these short dated options, which is, effectively causing the stock to maybe trade somewhat erratically, while the stock replacement strategies are not really swapping their exposure out too much like the retail traders are.
And let's unpack for a little bit more of I want to get back to the market makers and basically why are they, this is their business, but are they making money? When the market's ripping higher like this, are they making money hand over fist, or are they struggling? We have any idea on that?
I think so. I don't think that there's much pain going on, especially, if these retail traders are going home flat at the end of the day, that makes their job a whole lot easier. Where you could start to see pain is a position that's sitting on your book when a stock's going against you, vol's going against you, your short calls or call spreads.
So what are they? So to make money on that, they have to be over quoting it, right? Like selling it for more than it's quote unquote worth. But so what does that look like? The options.
Yeah, so you could look at like the IV, the implied vols in Apple, for instance. Obviously, a big potential target for this whole scenario. And implied vols in Apple were rising. It went from like 40 to I don't even know what they are today, 70 maybe. As all that call demand's coming in, the dealers are just raising the vols on them. So they're selling their product for a higher price, all else equal. And they know how to hedge, and there's plenty of liquidity to go out and hedge. It may move the stock around, yeah, but they've already sold their high vol calls to these guys. That's how they're making their money.
And so from the retail guy, he's going to buy it. Let's just make up some numbers, right? Say the true vol of some options 10. He's going to buy it. The market maker is going to sell to them for 20. Mm-hmm. And then even if the stock moves up, maybe the option settles at 18.
Yep.
So they're trying to say, hey, we know it's volatile, it's still moving, but we're going to price it even beyond how much it's moving.
Yeah, it tilts the edge to the market maker, and they do enough of these transactions, they're going to make some money over time. And anecdotally, a lot of the Robinhood type traders that I've talked with, usually it's a younger guy that might not even have tons of experience in trading options. He just wants to buy Tesla. He sees this call. He knows calls are for long, positions, and he just buys it. Has no idea what he's really paying for underneath there, other than Tesla up. So I feel like there's plenty of opportunity in there for a market maker to make a good living on that.
And definitely. And to your point about how they price these options, there was. I remember towards the end of August and September, you were seeing a 25 delta call on Apple trade at a premium to a 25 delta put. So you had an inverted skew where, that shouldn't theoretically occur in something like an equity. It definitely shouldn't occur in an equity index. But that was the case. And that's a great example of how market makers will adjust the prices of options to accommodate for this. So,
and in the past, wasn't it skewed the other way in the past because people were overpaid for downside insurance?
Yeah,
that's the typical shape of options skew. That's what they call it, a skew. It's usually to the put side, just because typically equities have a larger left tail than a right tail, or at least that's the perception.
And do we think these day traders getting run over? So are they losing billions en masse for the market makers gain, or what? Like, it seems like if that's the case and the market makers are kind of keep raising prices, selling you more and more, that someone's the net loser here and it's going to run out of money.
Yeah, and probably wasn't the market makers in total. I think probably a lot of money was pulled out, of the Robinhood set, if we're using them as a placeholder for retail.
But it's probably as U.S. taxpayers, right? Like, we gave everyone this free money, they're buying the calls with it, and it's
yeah, right. It's kind of not my money anyways. Yeah, right. If they could put a couple $100 in there, that's some decent upside in Tesla for a couple months.
And then, so let's talk. So everything we said is causing. I'm going to sell you this option, Mr. Retail Trader. I'm going to mark it up because you're so willing to buy it. I'm going to mark it up over what I think the option is going to move. So I'm going to make money if it doesn't move outside what we think it's going to move. And in turn, that's pushing the VIX or the NASDAQ VIX, which doesn't get quoted as much, but that's pushing both of those measures up because it's measuring the prices of options both on the call and put side. So someone make that connection for me. That's the last piece of the puzzle here. All this call buying, all the market makers hedging, but it's pushing VIX higher because it's pushing the option prices higher.
Yeah, it's sort of this like positive feedback loop where you get the vols and the options lifting, the curve, the implied vol skew turns more to a smile or a U shape. So you're getting lifted on the call and the put side. in those names. At the same time, the hedging activity is pushing up the stocks 4 or 5% a day. They're already enormous market caps. They're getting to be a bigger and bigger part of the S&P. They're getting to be an enormous part of the NASDAQ. So now the indexes are looking more and more like these 5 names that are caught in this vortex. And the indexes themselves start to get more volatile, and everything sort of just can lift at the same time like that. I think that's essentially what we saw at the end of August. And actually, you're seeing the opposite in September, maybe.
And so can we go back to the blow off top in 99? Is it similar dynamics here or no?
I don't have any specific.
There wasn't Robinhood or probably nearly as much retail.
Right. You know what a new thing in the 90s, late 90s was like just electronic trading in general. So you could get on an E-Trade account. It was harder to access the options market back then. But we did see, if you look back in the data from 97 to late 98, you had VIX and S&P rising generally together, and the NASDAQ going through the roof. So similar idea where vols were being lifted at the same time equity prices were.
I guess the corollary in 99 would have been the SOS bandits, right? Some of the online traders were retail platforms were marking the prices of the stocks themselves up. Mm-hmm. Being like, hey, if there's so much demand, I'm going to mark it up above the price.
Yeah.
And either their internal guys or SOS traders could come in, buy it cheaper, and quickly sell it to the new guy trying to get it higher.
Sure. Yeah. So now we just have a different access point and maybe more access to the options market. And we handed them a check for $1,200 a couple months ago. Right. And you've got the Fed out there basically, pushing equity prices higher. That's the mix.
So 2 more things. So who are these market makers? What are the names of these groups? So we're talking like Citadel, Susquehanna, groups like that?
Those are the 2 biggest in that space. I think Citadel is pretty prevalent in that short-dated tech-related call flow.
And they've been on record of Robinhood's statements of buying their order flow. And that's the other piece here, which has been well covered in the news. But the market makers are actually paying Robinhood, paying these firms in order to get those orders in order to trade against them. Do they pay just to see it, or they paid to basically be the market maker on the trade?
They pay to internalize that. So basically to be able to completely be on the other side of that order. In addition, there is information contained within that order that may or may not be of value to them. And so this is information about the type of trader, potentially the size of the account, a variety of information that clearly, if they're willing to pay 35 cents or 50 cents a contract, there's some value to them to be willing to pay that much money to, it's really, access to information, because
there's still the Robinhood platform itself has a duty to put an offer out to the whole world, right? They can't just sell the orders themselves, right, to Citadel?
Sure. I believe in, this is not my expertise, but there's some type of auctioning mechanism where here's what we're willing to fill the trade at, and here's the payment for the order flow that will be associated with that. And then they need to act in their client's best interest. They can't act in, well, we get the most from Citadel, so we're going to give them the trade. Right. It always has to be based on the, net execution cost to the client.
Right.
So
we want to allow the client to buy it as cheaply as possible. We're going to get 4 or 5 different quotes or whatnot. Mm-hmm. But I wonder if any of these Robinhood traders even know 1/10 of everything that's going on behind the scenes there. Like, it's been well covered that there's payment for order flow, but do they know that the dealers, right? They barely know what an option price entails in terms of volatility and time decay and everything. Do they know that it's also being marked up by these market makers?
Doubtful.
Well, and let's remember though, it's not, these are still public markets, so it's being marked up by, like an institution is free to come in and try and knock that price down if they think that it's so out of whack. You know, it's not like they're specifically marking the trade up just on Robinhood traders. You know, these are publicly traded markets, and so anyone can react on that information. You know, it is interesting to see the concentration of, you know, the Robinhood traders tend to focus on a very specific set of stocks and a very specific time frame. And I think that, you know, that tells you what you need to know about what they're interested in. You know, they want leverage, cheap bets on upside in stocks that they know that they think can go up. And, you know, I do feel that the payment for order flow, you know, some of the negative connotations around that, yes, you know, there is a very gambling mentality within the Robinhood traders, but, you know, it's also given people access to trade at the cheapest prices in history with, you know, minimal to no slippage.
Free.
And for your typical investor or trader who's not worried about making, you know, oh, I lost a penny on that execution or whatever, like I think that it ultimately benefits the end user.
Fair. Good point. I just feel bad for that kid who killed himself because he thought he was down 200 grand or something. So I feel like they've gamified it perhaps a little too much.
Yeah.
That it's actually real money and real people's futures. So, but I'd agree that payment for order flow is not necessarily evil. And one day we'll probably see it in futures markets as well.
It's just a different form of commission. You're moving it elsewhere. It's not you're paying a ticket charge. You are paying it just in a different form.
So let's move on. So this has spiked the VIX, but the VIX coming into this period here, September, October, with the election was already elevated. We've had a really weird looking curve where it was sharp into October and then falling off, but the whole thing's been rather elevated since March. So Matt, why don't you give us a little insight into what the curve currently looks like in the VIX and reasons for that?
Sure. In my view, it's pretty straightforward. It's like everything kind of centers around that October contract. The October VIX contract looks 30 days forward. That covers the election vol. So the October contract all year has had this big bump in it. And really since, I guess that August expiration period, you've seen that October contract just kind of consistently lifting up. And the whole curve is kind of, sloping down around it. So then the September contract has been dragged up a little, but the contango from September to October is about as steep as it's ever been. You know, it was over 20% for a little while, it's pretty outrageous. So it's a big roll there up. And then after October, you get this big slope back down. So it's obviously the market is pricing in some volatility around the election, and the prices in general are just super high. Even out into like next year, next spring, you have prices. I'm just gonna look at it here. Over 27 in the March contract, 28 today in the March contract.
Into next spring.
So that VIX market is like looking at major volatility around the election that persists for a long time. So, some of these scenarios people are drawing up where we're not going to have a clear winner for, who knows how long. It could be another, Bush Gore scenario or worse, depending on your outlook. That seems to be what's being priced in right now.
And then that's always weird to me because the October contract's looking forward 30 days. So it's the November option prices, right? So people are paying up for November protections, driving that higher.
Yep.
But if I'm a VIX trader, if I'm trading the VIX futures themselves, I'm not going to get the real-time action in the October contract as the election's unfolding. Election night, it's already expired.
Right. That's off the board.
Should be in both contracts, maybe, right?
Yeah, and so November is still trading 31.90 right now, so it's way up there too.
Yeah.
A normal November at this time of year in like 2017 type market, November would be 18. So you're talking, way higher than average here. So, and I don't remember it being anywhere near this close in 2016.
And typically what's the typical curve? We have backwardation.
Typical curve is contango. So, if vol's low today, the VIX is probably, an average VIX would be like 13, something like that.
Right. Yeah. Sorry. And we always think there's going to be some event in the future.
Yeah. Right.
The future versus the present.
Yeah. So, in that aspect, VIX, spot VIX, September and October are kind of they're contango, but at a high level. After that, it gets all weird, and it looks like a market crash basically after October has been priced in by VIX.
And then the typical trade and the typical, right, is harvesting that roll premium, selling front month, buying back months. What does that look like with this weird up then down curve?
Yeah, it's been a tricky trade really since, again, that August period, because you've had this nasty contango in the front months, which generally that's where most of the action is, the first couple months. You've had this enormous roll down that should be occurring in all else equal between October and September down to spot. And that has just stayed like that in that steep upward slope, and the whole curve has been lifting up. So the signal, look by the curve is like short vol for the roll down, but it's not happening. It's getting steeper and lifting higher. So the vol deck has just been raising over and over again.
And do we think that's partly a result of less and less VIX ETF products, VIX index products?
That's part of it. I mean, all the inverse exposure went away. A lot of leverage came out with TVIX being delisted. So now you have just way less leverage in all those products. VXX is the big game in town. There's no leverage there. It just owns the VIX futures and rolls them. SVIXY is a fraction of its former self.
Yeah, is it a quarter or something?
Yeah, I mean, it's like 90% lower than it was at its peak. I think, at its peak is probably over $2 billion. I think it's about 200 million today. So,
but then what do you guys read about even the non-ETF, like via swaps or whatnot or even not necessarily call replacement, but yield enhancing strategies of just selling vol? Seems like those have gone away since March as well.
Yeah. It seems like the positioning was definitely, kind of cleansed, and you had a lot of the over leveraged players in that space. We talked a lot about this on the last podcast, but I think that the reduction of the amount of assets being allocated to explicitly short volatility strategies that are either selling VIX futures or playing the term structure or variance swaps, those type of strategies definitely took a hit in their AUM, and in some cases, are no longer around and won't be coming back. And I think that, at the end of the day, volatility markets are just like any other market where they're going to be driven by supply and demand. And so I think, one of the reasons why you saw such a high, volatility risk premium, or the difference between, implied volatility and realized, is in part because there are just less people out there that are interested in selling volatility. It was interesting that for the first time in quite some time, there was a nice 3-month run where, your typical short volatility indicators actually did a pretty good job of getting you short vol at the right time. Where it started to get wacky is when a lot of these indicators that look at the front 2-month futures, when they started to incorporate some of this election volatility, one of the, I think, more popular indicators is looking at the spread between UX1 and UX2, the front 2 months. And, you can just get out of the way if it backwardates, and that'll, keep you out of a lot of the major equity sell-offs in the past. But unfortunately, if you're not accounting for the event risk that's inherent in the second month fixed future right now, that's not a good indicator to be using. I think that, a 4.5 point spread right now between September and October is not at all indicative of the overarching, volatility regime and how options market and, other volatility traders are looking at the potential risks on the horizon. So I think that, it's always important to remember that just like any other market, volatility is supply and demand driven. In 2017, you saw the extremes of just, ridiculous supply and no realized vol. And now you're seeing a lack of supply combined with, more risk on the horizon, increased realized volatility. So, it's certainly possible that some of these indicators and things that were consistent and worked in the past may not work as well in the future.
And so it sounds like you're saying we're in a new vol regime based on the new supply and demand of what has transpired. We're in a new vol regime. Don't expect every spike to have VIX go back to 13.
Sure. Yes.
It feels that way to me.
Well, the proof's in the pudding. We've been above 20 for how long now? Since February?
Yeah, probably one of the longer streaks I can recall for sure. And look at this year too. There's the buy right index that SIBO puts out and the put right index. So selling vol in that format, both of those are down over 10% this year. So that just goes to show how tough that's been. And I think it goes all the way back to 2018, like February 2018 when XIV unwound, and that sucked the life out of that vol selling trade. And the realize has been so high since that point. You've had these big 20%, and we just had almost 40% correction peak to trough in S&P. So you start to see that amplitude coming up, and it's actually paid since 2018 to actually own vol in total, like buy options instead of sell options. So I think it goes all the way back to 2018.
But if implied stays above realized this much right now, right? Where it kind of, I don't know if it's record highs, but especially in the NASDAQ, it seems that spread is huge.
Yep.
That would tell me to sell vol, right?
Yeah. Yeah.
All these retail traders are going to be like, dude, I keep getting the direction right, but I lose money. Like eventually they might say like, oh, I get it. Like there's all this volatility but priced in that I'm not getting. I'm only getting the price move. And they might start saying, oh, I should start selling it.
Well, and so one of the things is that, when we had scheduled this call, I think, at the time we were going to talk about the VRP and how, the VIX was so high, but the market isn't realizing a lot of volatility. But, since then, you have seen realized volatility start to catch up towards implied. So that spread has narrowed a lot. And one of the things that's worth pointing out is,
when that was basically last Friday and today, right? Of like the NASDAQ down basically 5% each day.
Mm-hmm. And so, and one of the things that you can kind of back in without getting too fancy with math, you can look at a ratio of the VIX to something like volley, which measures the 30-day at-the-money volatility, whereas VIX is basically the strike price of a variance swap with the same maturity 1 month. And that'll give you a metric that will tell you how much convexity premium is being priced into the S&P 500. And that tends to sort of track something that looks like, skew in the S&P 500. And what you saw was ahead of, the market sell-off, the VIX was trading at almost a 35% premium to what at-the-money volatility was. And so, when you're comparing, at the money volatility to realize, that spread was much smaller. But, at the end of the day, the VIX is very heavily influenced by these far out of the money options, which rightfully are, very bid up.
And as you said, that's where a lot of the open interest is. So.
Right. And primarily in the S&P 500, the NASDAQ single names, they have a very different open interest and, just dynamic of where people want to trade options. And so I guess, one of the points there is that because the market was pricing in a tremendous amount of downside risk as we were rising, as the S&P was rallying in late August, that explains to me that people were also going out of their way to hedge, and that, people were kind of ready and expecting a drop like this. And that's the exact reason why you see days like today where the market falls by almost 3% and the majority of the VIX futures are down 1% or, 1.5 to 2 points. Spot VIX was up, not even a full point, quite an underreaction compared to what you would expect based on the move in the market. And I think that it speaks to the fact that, people were anticipating something along these lines, which explains why the VIX was so persistently high coming into the,
Right. So it's like, hey, if we had market up, VIX up in mid-August, it's not surprising here to have market down, VIX down.
Exactly.
Right? And like Matt, you said in the beginning, point to point, we're about where we should be.
Yep.
It got weird then and it's weird now.
Yeah.
So Yeah, which leads to, is this going to normalize? Are we going to see some back to kind of what we would expect the relationship to be, or is this the new normal?
I would expect, I mean, it's got to normalize or else, downside protection is going to start to get way too cheap, essentially, or I guess upside participation, the way you look at it, depending on how you look at it. So you got to figure that the market forces are going to come in here at some point and things are going to stabilize out. Or, the market will move in a way that catches more people off guard one way or the other and get to rethink.
Another way of saying either realize is going to catch up with implied, you're saying?
Yeah, that's another way to put it. Yeah, that's a cleaner way to put it. Yep.
Or vice versa, or it'll come back down to reality. But then that goes against what we were saying before. This is all driven by this kind of like artificial call buying.
Right. Yeah. That could be a second factor would be whatever gets people. Maybe the next stimulus check comes out and it's another $1,000 or whatever. I mean, and we start getting back into this. Hey, I just got some more house money back in my account and start loading up the calls again. Possible. We start seeing this thing persist a little longer than we thought.
How does this work for your guys' strategies? Is it a non-event, or is it worrisome? Is it exciting?
For us, it makes it tricky because, we use a lot of the same indicators that Pat was mentioning. The shape of the term structure is important to us in terms of signaling how the VIX market feels about risk. And when things get turned on their head like they have been in the last few weeks, that message can be confusing. It can almost be the opposite. So it changes the way, we're getting like this stress, in August, we got these stress-like signals while everything was going great in the S&P. So it puts us in this weird, unique spot where we're starting to put on hedges when the market's making all-time highs. And we're just watching what's happening in the VIX and putting these hedges on. And now the market's starting to drop and we're backing away from the hedges. So for, a lot of our investors, it's like, wait, you guys are doing this backwards here.
Yeah.
The VIX is doing it backwards.
Yeah.
Yeah. For us, we actually, the mutual fund that we use, the way that we implement that hedged equity approach is, in a sense, stock replacement. And so we are long call options in a conceptual sense, maybe not in a literal sense. So vol up, spot up is very good. We love vol up, spot up. Our up capture was very good in that situation. And, our models try to adjust. They recognize the fact that that is a temporary phenomenon, that vol up, spot up, shouldn't persist for months at a time. That's not to say that, generally, like in the 1990s, the VIX and the S&P trended higher together. But if you look on a day-to-day basis, the correlation was still negative between those two. And so, in general, our portfolio is long gamma and it's long vega. So we love when the market moves. And, we've actually, one of the trades that we've liked, given how, steep index skew was putting on put ratio spreads to hedge the downside. We understood that performance is good when vol and spot go up together, but how do you hedge against that? And how do you kind of lock in some of those gains without taking all your chips off the table? And so, our preferred way of doing that is by trading put ratio spreads on the S&P 500 instead of doing something like just buying a put. Because when you're buying a put, on a day like today, despite the fact that the VIX was up across the board, S&P options, on a fixed strike basis, implied volatility got creamed. And especially so in some of these longer dated expirations. And so the way that, that is the biggest risk to our core positions. And so the way that we hedge that is through using put ratio spreads to effectively get somewhat shorter volatility and shorter gamma as the market comes down. And it can, they do very well on days like today.
How do you square what you said with vol up, spot up with, it would seem you're buying these call options, but they're overpriced is what we kind of talked about before, Or you're nimble enough to get them for not overpriced?
Well, I think that it's a bit of a generalization to say that they're all overpriced. I mean, there's 12,000 options on the S&P. If you look at the NASDAQ too, remember the VRP and looking at, the implied volatility you pay versus what is realized, that is relevant if you're, delta hedging and trying to remove all the price risk from that option. But at the end of the day, our investors hire us to, they want market exposure. They just don't want that nasty 35% pullback. And so if you have the propensity to actually own that delta, you can use some of these nuances like skew, like the term structure, to kind of optimally structure a long delta or a bullish position, but that will still give you asymmetry to the overall market. And so, I think options tend to be very well covered in the very vanilla sense, covered calls, iron condors, put selling, and they're also very well covered on the, volatility arbitrage side, which is, just what market makers are doing and what, proprietary traders are doing. They don't want price risk. There's a gray area in between that we feel, that's where our edge is, and that's where there's opportunity.
Some price risk, some vol risk. Yeah.
Right. And you can use things like skew to give you asymmetry to these markets. And so, I think that overall, if you're willing to stomach that price risk, that, calls are not as expensive as they may appear.
And then coming back to the market makers for a second, do we think some of this environment is because there's too few market makers now? Like there's been some downsizing. The banks have gotten out of the game. Like if it was only Citadel, they could mark whatever price they want. So if you take that to its logical conclusion, the fewer there are, the worse it is for a market, and the more this feedback loop could feed on itself.
Yeah, I think that the overall space has shrunk and balance sheets are a little tighter, and so that all feeds into that how willing they are to take any kind of directional risk and how incented they are to go out and hedge that book very tightly. And that kind of feeds into this kind of thing in the right scenario in these big mega cap names. Maybe that leads to what we've seen in the last couple of weeks.
And then you also have the dynamic at the same time, the winner take all in the markets themselves of Apple, right? The FANG are the biggest. Wasn't Apple worth more than the whole Russell 2000, I think?
Yeah.
Last week or something, right? So you have this winner take all scenario going in the individual names, plus the market makers kind of carving out their niche.
Yeah. My brother said, he had the best comment. He said that it's the winner's pool is like a hot tub now. Just a couple guys sitting in there.
But in theory, it makes it more fragile, right? And more susceptible to some systemic risk of one of those pieces breaks.
Yeah. And people on the way up in August, looking at the breadth, we kept seeing these terrible breadth numbers in the NASDAQ in particular, but all over the place. As the market's making new highs, breadth's getting worse and worse. And the argument is, well, it doesn't really matter because these 5 names represent most of the index. So who cares what the other 495 are doing in the S&P? And then the inverse is happening potentially now. You had, I think, 70% of the NASDAQ components today were outperforming the index. It's just that the 30 that were getting creamed are 55% of the index. So, that works both ways. Yep.
And so let's talk that quickly. Would this feedback loop happen on the downside as well? Or there would need to be mass retail buying and institutional buying of puts and whatnot, and then the dealers are gamma hedging on the downside?
Yeah, I think in theory, and Pat can probably speak to it better than I could, but in theory, the demand for those 2-week Tesla calls evaporated today. Tesla was down 21% today. Probably people are pulling away from that market rather than charging into it. And then that creates the opposite. If there's still, that inventory on dealers' books, now the delta's moving a completely opposite way, and they need to go, in theory, go reverse to hedge out those deltas. And especially on a 20% move in that name today, maybe it would have been 10% if, X all this call overhang on their books.
I think he just, right? They announced the split. He raised that new offering. Then they didn't get in the S&P, but they're like, hey, we got our money out of the thing now.
That's right. Maybe they should split again. I don't know.
good, guys. I think we've covered all. Any other nuanced pieces that we've missed? Where do we go from here?
Well, we got the Fed next week. Maybe they'll right the ship here, and then obviously we're getting into election season pretty hot and heavy. So I think it's all just going to depend on, unfortunately, polls and the latest tweet.
And you mentioned, Matt, you thought that what's being priced in is there's like a dispute of the election. Is that what you were getting at?
I mean, it seems to be. So the October contract, the election itself, you're at 35 vol, traded almost 40, which is, previous to this year was pretty unheard of. So the election itself, but very volatile. And then afterwards, you had your upper 20s, lower 30s, upper 20s, all the way out till March. And if the market was really just worried about the election night itself, and then, we have a winner and we move on with life, I think you'd see those farther out contracts a little more at a discount. So if this thing drags on for, if it's January and we don't know who the president is, yeah, mid 20s vol is going to seem on the low side, I would imagine.
That's interesting. I hadn't heard that take before. My thought was just people are thinking it's going to be Biden and he's going to tank the market and introduce new taxes or regulation or whatnot.
Yeah, and maybe that was part of it, like early on in the year when there was that bump in October, and it's been there throughout the whole time. But now it's a bump on top of a bump, and this thing's close to 40. I mean,
right, it's a bump on the whole curve is elevated, right?
Yeah, right. So now there's like this big systemic kind of thing being priced in, I think.
And then what if we get a vaccine tomorrow? You think the whole curve comes down 10 points or what?
Yeah, you got to figure. And that would take a big part of that left tail out, I think, especially on obviously the GDP and earnings and everything. And you can start painting in some better scenarios for earnings next year. The market got quite a bit the way they're already, I think. But yeah, the vaccine would definitely help, especially if the vaccine was announced on like November 10th or something, or shortly after the election.
Oh, it will be. They'll time that perfectly.
That's right.
And what else? Oil, dollar, anything? Any thoughts on those guys? Who cares? Your vol traders.
Right. I mean, we look at. I like to look at junk bonds and corporate credit in general, because that seems to be the linchpin of this of the Fed's focus this year. Is let's shore up that corporate bond market. So we've been watching LQD and JNK are pretty easy proxies, and LQD is quite a bit off its highs, and it's actually trading back down almost to when the Fed said they were going to start buying that debt. So that's interesting for me to watch. I don't see how equities go up and vol goes down if LQD and that junk bond market or the investment grade corporate bond market is having trouble. Mm-hmm. So we're watching that.
I think there's, over the last few days, your traditional portfolio 60-40 or risk parity strategies have not fared too well. And I think that, at the end of the day, that's how 99% of people are invested in the market. So that's always a good gauge for, where is their pain and how much pain are people feeling?
Yeah, I think I tweeted out, I can't remember what day it was, Thursday or Friday, of like market down, gold down, bonds down, VIX down, nowhere to hide.
Nowhere to hide.
Bitcoin might have been down too. All right, guys. This has been fun. Matt, why don't you tell everyone where they can see you on Twitter and whatnot?
Oh, sure. So Twitter, at Dynamic Vol, and Thompson Capital's website is thompsoncm.com, like capital management. And
Pat, in case people didn't write it down last time you were on.
Yeah, my Twitter is Pat_Hennessy, and if they want to check out the firm, the website is investps.com. If you have any questions, just reach out, send me an email. I'm always happy to, talk shop, talk volatility. It's always exciting.
It's fun. All right, guys, it's been fun. We'll reconvene when VIX is at 110 or something, and a general gets appointed president or some weird scenario in there.
All right, you got it.
All right,
thanks, Jeff.
Thanks, Jeff.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlt and visit our website to read our blog or subscribe to our newsletter at rcmalt.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.